Good morning and welcome to our webinar on tax planning ahead of the new tax year. I'm Helen Cuthbert, a director in the private client team here at Menzies, and with me is Mark Williams, financial planner with Menzies Wealth Management. We are going to take you through a number of key points to consider ahead of the new tax year, particularly given the rise in tax burden announced in the autumn statement. The webinar will be recorded and this will be made available to you after today's session, which we expect to run for around 35 minutes. Please feel free to post a question in the chat and we will make sure that we come back to you separately after today's presentation. Thank you to those who've posed questions in advance. We've tried to incorporate those questions as we go. The disclaimer then. This is the standard disclosure that we are required to make from an investment perspective. Today's session is for general information and does not constitute advice or recommendation. Please feel free to read, and if you have any questions, please come back to us. Starting then with the key changes from a personal tax perspective. The key theme from the autumn was the freezing of most personal tax allowances until April 2028. Here are the highlights of the personal tax regime, which will apply from April 2023 onwards. The freezing of the personal allowance at 12,570. We already knew it would stay for a number of years, but now we know it's going to be with us until April 2028. A reduction in the additional rate 45% tax bracket down to £125,140. Currently sitting at 150, so that's quite a drop. According to an HMRC policy document, some 232,000 people will now pay 45% due to that decreased threshold. A reduction to the dividend allowance, down to £1,000 from the current £2,000 from April 2023, and then further to £500 in April 2024. Capital gains tax allowances slashed from 12,300 to 6,000 from April 2023 and to be further reduced to 3,000 per year from April 2024. This will result in many taxpayers paying capital gains tax for the first time, increasing administration and of course bringing more people into self-assessment. The reduction in the CGT allowance means that it is no longer always sensible to consider inter-spouse transfers, for instance, to utilise the annual exemption. Perhaps consider staggering sales across tax years or pulling that sale into the 22-23 tax year, particularly where the asset held is perhaps a slightly more liquid asset such as shares. Inheritance tax nil rate band frozen now until 2028, as well as the property nil rate band that sits above that. Again, this is going to move more individuals, more estates into the IHT net as asset values increase over time, but the limit remains static. Inflation in asset values will only add to the issue. The IHT nil rate band has sat static since 2009 now. Next slide, please. So considering now some pre-April 2023 planning points, consider accelerating income to utilise the full 40% bracket within the current year. Currently available, as I said, up to 150,000. May bonuses be paid early? But again, watch the conflict there with a company who may be better placed deferring payments until the rise in the corporation tax rate to 25% from April 2023. Consider the timing of share rewards and options, the fair release and losses, trigger income tax losses perhaps on assets that are sitting at negligible value. Consider delaying gift aid donations, particularly if they're significant donations, until 23-24. However, in doing so, beware the 60% effective tax bracket that sits within the 100k to 125-140 income bracket where the personal allowance is tapered away. Let's move on. Consider pension contributions to restore, both in terms of levels and timing, perhaps to restore the personal allowance. Is it worth making a large pension contribution now? or deferring that to 2023-24 to restore the allowance and to remove that 60% threshold. Need to consider the annual allowance, relevant earnings, carry forward allowances, potentially deferring pension contributions until after April 2023. Mark's going to cover that in more detail shortly. The reduction to the dividend allowance, as we talked about, down to £1,000 in April 2023 and then dropping to £500 in 2024. Consider accelerating dividends in personal and family companies into the 22-23 tax year. The answer does depend, it's very much dependent upon the level of income. Spread dividends across various share classes as appropriate, but be really careful to take bespoke advice here. The balance between dividends and salary needs careful consideration. Now that tax rates have increased in the personal tax environment and the corporation tax rate will increase to 25% from April, remuneration strategies should be reviewed. The tax position does bring out some surprising anomalies which do not necessarily follow previous logic. Where properties are held personally but used by a family or personal company, rental income is not subject to our increased dividend tax rate that we've had for the last year and will continue into the future. Therefore, if you have a personally held asset that's used by the company, consider paying rent to extract that value tax efficiently. One of the few remaining changes and incentives which remains from Liz Truss's administration is the stamp duty land tax change. So the SDLT, there was a £125,000 increase in the threshold that came in September 2022. That's now been made temporary until 31st of March 2025. So where relevant, make sure that that's utilised. So pull forward purchases before the change occurs. Other possible things to consider would be gifting assets now while values are low, thus minimising the capital gains tax charge. Consider selling an asset and then popping the asset into an ISA, selling the asset and have your spouse repurchase those shares. There are many points to take into consideration here. As always, any planning needs to be considered in the round. I'm now going to hand over to Mark, who will run through various financial planning considerations. Thanks, Mark.
Thanks, Helen. As Helen has highlighted, tax allowances are either being frozen or reduced. And this will cause many more people to pay greater taxes than perhaps they would expect. It's therefore essential that we manage our financial affairs to mitigate tax where possible and to take advantage of the tax planning opportunities where they are available. When it comes to investing, there are a number of tax-efficient strategies that can and should be used. First of all, there's individual savings accounts, or ISAs. Any money put into an ISA is free of tax on interest, dividends, or capital gains within the ISA. ISAs can either be cash savings or investments. For the last few years, tax on interest income in savings hasn't really been much of a concern due to the very low interest rates. And for many people, this was covered by their personal savings allowance. However, as more people become higher rate taxpayers, their personal savings allowance will be reduced from the £1,000 for a basic rate payer to £500 for a higher rate taxpayer. And for those on the additional rate level, which is dropping to just over £125,000, they won't have any personal savings allowance. So, with the recent increases in interest rates, it is possible perhaps to get nearly 5% these days on savings, say of £10,000. This would produce an interest income of about £500 and would use up the personal allowance for somebody who is a higher rate taxpayer. So you need to be quite careful with your savings now and shelter them as much as you can. You are, however, also limited by the amount of money you can put into an ISA. And this is £20,000 a year for each person. So for a couple, that could be £40,000 that you can safely tuck away in a tax efficient vehicle. You're also able to put up to £9,000 in a junior ISA, perhaps to save for children or grandchildren. And it's also possible to put £4,000 into a lifetime ISA, which is a slightly different vehicle, has some benefits, but also reduced flexibility. Regarding the flexibility of ISAs, normal ISAs are very flexible when it comes to taking withdrawals. There basically aren't any rules as to when you take your money out. And you're even able to put some money back into your ISA if you've taken it out earlier in the year. As long as it's within the same tax year, that money can be repaid back into the ISA. Junior ISAs, however, can't be accessed until they're 18 years old. And lifetime ISAs, you're only allowed to access when you reach 60 years old or when you buy your first home. Otherwise, there's a penalty. Now, the penalty exists on lifetime ISAs to reflect the government's contribution of 25% of your contribution up to a maximum of £1,000. So if you were to put the £4,000 into a lifetime ISA, the government would give you an extra £1,000 and your total savings would be £5,000. There is also an age restriction on lifetime ISAs, and you can only do this up until the age of 40. But it does create an alternative vehicle to pensions and can help save for that first house. ISAs can also be used for investments. And when they are used for investments, all the dividends, interest and capital gains on those investments is free of tax. So with the allowances on dividends being reduced and capital gains, this becomes much more valuable than perhaps in the past. So ISAs are certainly something that should be considered for your investments. Pensions are another tax-efficient savings scheme that are more specifically designed to help save for retirement. They have a number of features that are important, and I'm just going to run over those as a refresher. First of all, there is tax relief on any contributions to a pension. For employers, pension contributions are fully allowable as an expense of the business and can be deducted against the income for that business, so forming a very valuable way to reduce corporation tax. However, contributions are limited. For personal contributions, the maximum you can put in is limited by the amount of money that you actually earn. This is also capped to £40,000 or maybe a lower tapered level, depending on where you earn, for total contributions, whether that be employer or employee contributions. Within the pension wrapper itself, there is no tax on any interest or dividends received within the pension wrapper, and any capital gains are also free of tax. So it's a very good vehicle to grow investments over the long term, which is what this is designed to do to help with retirements. However, the government do get some taxation, and this happens when you take out withdrawals later on at retirement. There is, of course, the first 25% that you can take out as a tax-free lump sum. And anything over and above that 25% is then taxed as income. Now, there is some flexibility as to how you take withdrawals, and you don't need to take all the tax-free lump sum in one go. You can take it in portions, and you can leave some of the pension, what they call uncrystallized, and take a tax-free lump sum at a later date. So this flexibility allows you to plan your withdrawals from your pension that can be partly tax-free and partly taxable. The one thing to note with pensions, it is designed for retirement, and therefore no withdrawals are allowed until you're 55 years old. And this level is rising in 2028 to 57 years old, and might rise again in future, as the policy is that it should be 10 years less than the state retirement age. And they are talking about that raising to 68 and maybe even later for the younger generations. So just to be mindful of that. Thank you. So where are the planning opportunities with pensions? So as I mentioned, pension contributions you get tax relief on. What they do in effect is reduce your income. So they can bring your income down to a lower level. And the opportunity there is that where you are perhaps moving over a threshold, maybe into the higher rate level, about £50,000, or those with income over £100,000, where you start to have your personal allowance tapered away, this creates an opportunity for you to get the benefit of relief at higher levels. It's also possible to use carry forward for your pension contributions from the previous 3 years. So if you haven't maximised your pensions in the last 3 years, you still have the opportunity to do that should you have sufficient earned income. For a company, the contributions are deductible as an expense and against corporation tax. Therefore, there is an opportunity for a company perhaps to defer pension contributions to next year and receive greater tax relief at the higher level of corporation tax. Another opportunity that does exist and should be used is for those that perhaps aren't working and don't have any earned income. You are still able to contribute £2,880 to a pension and receive tax relief of 20%. This is quite a valuable benefit and creates opportunities, particularly between spouses if one of them isn't working. One consideration is the lifetime allowance. This is the total amount that you can have within a pension before it is subject to a charge. It's not really a cap, but it does mean that anything over this cap is subject to the 25% charge. Now, this originally came in at 1.5 million and rose to 1.8 million. However, successive governments and budgets have reduced this down to just over £1 million today. While that still seems a very healthy level, it is frozen for the next 5 years. And if policy in the past is anything to go by, it will probably rise by something like inflation, which is normally below wage inflation levels. So people will get closer and closer to the lifetime allowance level. For example, somebody who is 50 years today with a pension of £600,000, so only just over half the current level of the lifetime allowance, will likely be hitting the lifetime allowance level by the time they're 67. That's just based on investment growth and without any further contributions. So the lifetime allowance is no longer a consideration for the ultra wealthy. Another opportunity is investment bonds. Investment bonds are an insurance-based investment wrapper or account. They have a number of unique features that are quite different to ISAs and pensions, and they are particularly attractive for those people who have already used their ISA and pension allowances and perhaps just have investments in a normal investment account. It's unwrapped and has no tax benefit. So there's onshore and offshore bonds. Offshore bonds within the wrapper don't pay any income tax, dividend tax, or capital gains tax. Onshore bonds, on the other hand, are subject to UK life fund taxation, and they pay tax. For interest income and capital gains, they pay this at 20%, but there is no tax on dividends. This gives an effective tax rate of around about 16 to 17%, depending on how the bonds are invested. Now, the investments within a bond are very much the same type of investments as you would put into an ISA and a pension. So there's nothing unique in that situation. It's just the way that they are taxed. Now, outside of the bonds, when you take withdrawals, these are deemed to be potentially chargeable events. And this is where you can incur the taxation at a personal level. The original capital is not subject to tax. So if you were to cash in the whole policy, the original investment will come back to you without any tax. But the surplus, the growth that you've achieved on your investment, would be subject to taxation. You don't always have to cash in the entire bond, though, to get the original capital back without any tax. You can take 5% tax-free withdrawals of capital every year from the bond. And these also accumulate over time. So if you don't take it 1 year, you can carry it forward to the next year and subsequent years. This is quite a useful and very valuable opportunity within this to take income from an investment bond. As I've mentioned, the profits and growth of an investment bond are taxed when there is a chargeable event, which is basically when you take out the profit. And these profits are subject to income tax. So for an offshore bond, the whole gain is subject to income tax. As I mentioned previously, there's no tax within the wrapper as it grows, so the government want their opportunity to get this tax when you cash it in. For onshore bonds, however, that already pay some tax within the wrapper during their lifetime, the gains are subject to income tax, but they do come with a 20% tax credit. So for a basic rate taxpayer, there is no additional tax to pay when they cash in their investment bond. It's also possible to take advantage of top slicing relief. This is where the gain that you made on the bond can be spread over the life of the bond and reduce the potential tax payable. It's a bit of a complicated tax calculation, but it really helps spread this so that people don't get accidentally caught out as being higher rate taxpayers when really they are just a basic rate taxpayer and have held the bond for a long period of time. So what are the opportunities with investment bonds? As I said, they're quite different to ISAs and pensions, but they do allow valuable planning opportunities. The first opportunity is the ability to manage the chargeable events. This is when the bond is subject to taxation at a personal level. If you were to hold a normal investment account, that would receive dividends, and as you trade the shares within that account, there would be capital gains. And these you don't really have as much control over. They happen in the year in which they do. Within an investment bond, as they say, this only happens when you withdraw money from that bond. And this is how you can manage your chargeable events. The advantage of this is that you effectively can defer these events until a later time, perhaps when you're a non-taxpayer or a basic rate taxpayer. Also, bonds are split into a number of segments. It could be 100 segments. It's really depending on the way you set it up. And it is possible to assign these segments either individually or as a whole to another individual or to a trust. When you assign these, it does not cause a chargeable event. And the person who receives them would only be subject to tax when they then cash in the bond. The advantage from this point of view is that it also doesn't create a capital gains liability for the person who perhaps makes the gift of these investments. As I've said also, the 5% tax withdrawal. This is in effect a return of capital. So 5% would last for 20 years. The great thing about this is it could provide an income for the person who holds the bond, and this income would not need to be reported as self-assessment because it is not actually income in their eyes, but a return of capital. This can be very important for tax planning for both individuals and also for trusts. The fact that you can also place the bonds in trust is very useful. It can help with estate planning for individuals, and it can help the trust manage income and capital gains liabilities going forward, especially with the reduced allowances that have been happening in the latest budget. So investment bonds provide an alternative to a normal investment account, and perhaps can be considered if you've already utilised your ISAs and your pension opportunities. Thank you. I just want to touch on one other area that can also be quite interesting, and these are enterprise investment schemes and venture capital trusts. Both offer a 30% tax credit on any investments as long as they're held for a minimum period, which is 3 and 5 years for EIS and venture capital trusts. They don't actually reduce your level of income, but you can use that tax credit to reduce your tax liability. Where they are interesting with the reduced allowances that have been announced in the budget is with regard to capital gains tax, which VCTs are free of, and EISs. For EISs, this is after the 3-year holding period. Also, for venture capital trusts, dividends are exempt from income tax. And again, this is the benefit with the reduced dividend allowance. However, I would caveat that these are higher risk investments, so they tend to invest in smaller and earlier stage companies. And this might not be suitable for everybody, and really should be considered perhaps when you've utilised your pension and ISA opportunities. Thank you. A last consideration is with regard for people who do have investment portfolios that are not within tax efficient wrappers. And this concerns the way dividends and capital gains are taxed. For an individual, dividends are taxed. They have a small dividend allowance, which is decreasing now to just £500 a year in a couple of years' time. And after then, potentially, as a higher rate taxpayer, you could pay dividend tax at 33.75%. Capital gains for a person is at 20%. So therefore, you might wish to tailor your portfolio to produce more capital gains than dividend income so that you don't pay as much tax as you would otherwise. The reverse happens for a company. Dividends received within a company, such as a FIC, are free of income tax and corporation tax, whereas capital gains would be subject to the corporation tax levels, which are increasing. So for a company that is investing, they may wish their portfolio to be more tilted towards dividend-paying investments and less for those that are likely to produce capital gains. I hope this has given you some flavour of some of the opportunities that do exist within taxable investment opportunities. I'd now like to pass back to Helen, who will talk a little bit more about business situations.
Thanks, Mark. Bringing tax into the 21st century is a key aim for HMRC, and an important step in that process is making tax digital. MTD. The aim is to move tax compliance for certain individuals to a real-time regime. The regime will be mandated for all sole traders and landlords with income over a particular threshold from April 2024 originally, but this has now been delayed for 2 years. A key factor in enabling MTD is a significant change to the timing of taxation for unincorporated businesses, so for self-employment income and partnership income. This is timetabled to take effect from 24-25, and as yet that date has not been pushed back. So decisions need to be made now in terms of whether to change a firm's year end and think about the cash flow implications. So from 24-25, self-employed individuals and, as I said, certain landlords will be taxed on the profit made in the tax year in real time. At present, they are taxed with a time lag, being taxed on the profits made in the accounting year that ends within the tax year. A subtle difference, but with significant effects when they have, say, a May year end. 23-24 will be a transitional year, and in that year, profits generated in the current accounting year will be taxed, together with profits from the end of the accounting period through to 5 April 2024. This bumpy year of profits will then be reduced by any overlap profit brought forward, and that's the double taxation of profit from the very earlier years of trade. The additional net profit for the year will be known as transitional profit and can in itself then be spread over 5 years. The transitional profits will fall to be taxed at the rate in place at the time that that profit is taxed, so we are somewhat at the mercy of any tax rises and changes. There will be a significant cash flow impact for 31st of January 2025 following the first year of change. The administrative and accounting side will be complex, and sole traders will need to apportion their profits if they do not change their accounting year to run to, say, the 5th of April, 31st March being taken as being coterminous with 5th of April. It is likely that tax returns will need to be prepared on an estimated basis due to the real-time nature of the information required. It may result in perhaps individuals considering changing their optimal date of retirement for those anticipating retiring soon. The transitional profits will uplift income for a number of years following the change, and this will inflate tax payments. Good news is that the transitional profits are not included as income for certain purposes, such as restricting the personal allowance, the high income child benefit charge, and restricting the annual allowance for pension planning purposes. Our key message is take early advice. Moving on then, please. Wealth planning. Now is the time to think about wealth planning and succession strategy. If we are indeed now in a recession, then tax planning becomes even more key. Consider crystallizing losses through sale or gift. Identify assets to gift now, perhaps, that are sitting at a reduced gain, making use of the current capital gains tax exemption before it starts to plummet. So accelerate those gifting plans, perhaps. Consider the current values of your assets. Do not hold off. If the ultimate plan is to gift the asset, gift it now while the gain is lower. Of course, tax is only one consideration, and the investment piece needs to be considered carefully. Watch out for clogged losses. So that's where an asset is gifted to a connected person at a loss, most typically a family member. There's more restrictive use of capital losses than is generally available in that instance. Watch the knock-on effect for inheritance tax implications. Lifetime gifting can trigger an inheritance tax hit. Doesn't necessarily take effect at the time the gift is made, but can do if the individual making the gift dies within 7 years of making that gift. Insurance can be useful here, so speak to Mark. Some individuals may consider the setup of a family company to hold investments. Even with the increase in corporation tax to 25%, family investment companies, or FICs, retain a place in tax planning and family wealth planning. Consider transferring assets that are held already into a FIC and doing this while asset values are potentially lower. Next slide. As mentioned, so therefore, consider the use of a FIC, consider transfers in now while gains are lower. Consider the asset base within that company ahead of the corporation tax rise. As Mark mentioned, dividends are mainly tax-free in a corporate environment, but do watch the double layer of taxation on extraction of profits for the corporate. The inheritance tax nil rate band freeze, putting more estates into inheritance tax reporting and charges, as we touched on earlier. Consider the value of an estate if it's worth over £2 million. The 2 million threshold is key for the availability of full nil rate band thresholds of £1 million per couple. This takes into account the nil rate band plus the additional residential nil rate band. The residential band is tapered away where an estate is worth over 2 million. Can that estate value be reduced before death? Seek advice. Lifetime gifting. Often we look at claiming a normal expenditure out of income exemption where people can afford to give away surplus income in lifetime. Can you still afford to make the gifts that you have been making with the increased cost of living? Do you need to rethink your regular gifts out of income to ensure that they are truly being made from surplus income? Be careful with individuals who suffer with dementia when it comes to capacity to make gifts, something we're seeing increasingly. So think about getting suitable tax advice, but also legal advice at the appropriate moment. That brings us to the end of our technical information. What we're going to do now is pop up a poll on the screen, which gives you the opportunity to tell us some key areas that you would like to speak to your advisors about, perhaps on an individual basis. And now over to Mark for some closing comments.
Thank you, Helen. The budget at the end of last year aims to raise significant tax revenue to meet the shortfall that we're currently experiencing. And they've done this mainly through freezing allowances and tax bands, and not through explicit tax increases. As incomes increase over the next 5 years, this is going to cause many more people to become higher rate or additional rate taxpayers. Many people will also lose their child benefit, lose their personal allowance, and see a reduction in their personal saving allowance. And many poor people are likely to need to fill in self-assessment due to the increases in income that they're likely to experience. Excuse me. While it may be not possible to completely avoid higher taxation levels, there are a number of actions that can be used to mitigate these where possible, whether this be making pension contributions or possibly deferring contributions, or to bring forward income to this year or capital gains so that they benefit from the lower charges this year before they rise in future. The options available will very much depend on your individual circumstances. And we at Menzies would certainly be able to advise on your specific circumstances and the best options for you to take a look at. So please speak with your Menzies contact or get in touch with either Helen or myself, and we'll be happy to help you. Lastly, I would just like to thank you for your time today and wish you all the very best for your tax year end planning and for 2023. Thank you.
Thank you.